name is Miguel Gonzalez, and I'm a certified retirement counselor with over 20 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. Let's talk about the 6 potential 401k rollover pitfalls and how to avoid them. So you're about to receive a distribution from your 401k plan and you're considering a rollover to a traditional IRA. While these transactions are normally straightforward and trouble-free, there are some pitfalls you'll want to avoid. Number 1, consider the pros and cons of an IRA rollover. The first mistake some people make is failing to consider the pros and cons of a rollover to an IRA in the first place. You can usually leave your money in the 401k plan if your balance is over $5,000, at least until the plan's normal retirement age, typically 65. And if you're changing jobs, you may also be able to roll your distribution over to your new employer's 401k plan. Though IRAs typically offer significantly more investment opportunities and withdrawal flexibility, your 401k plan may offer investments that cannot be replicated in an IRA or cannot be replicated at the equivalent cost. An IRA may give you more flexibility with distribution. Your distribution options in a 401k plan depend on the terms of that particular plan, and your options may be limited. However, with an IRA, the timing and amount of distributions are generally at your discretion until you reach age 72 and must start taking required minimum distributions, RMDs, in the case of a traditional IRA. 401k plans offer virtually unlimited protection from your creditors under federal law, assuming the plan is covered by ERISA. Solo 401ks are not, whereas federal law protects your IRAs from creditors only if you declare bankruptcy. Any IRA creditor protection outside of bankruptcy depends on your particular state's law. Required minimum distributions from traditional IRAs must begin by April 1st following the year you reach age 72. However, if you work past that age and are still participating in your employer's 401k plan, you can delay your first distribution from that plan until April 1st following the year of your retirement if you own no more than 5% of the company. 401k plans may allow employee loans. IRAs cannot allow loans. Most 401k plans do not provide an annuity payout option, while some IRAs do. More 401k plans may begin to offer annuities because legislation passed in 2019, the Setting Every Community Up for Retirement Enhancement, or how we know it, the SECURE Act, has made it easier for employers to offer annuities as part of the plan. You can also take a lump sum cash distribution, but keep in mind that income taxes will apply. Also, if you're under the age of 59 and a half, the distribution may be subject to a 10% early withdrawal penalty unless an exception applies. Depending on the amount of the distribution, you could also end up with a sizable tax bill. Pitfall number 2 to avoid. Not every distribution can be rolled over to an IRA. For example, RMDs cannot be rolled over. Neither can hardship withdrawals or certain periodic payments. Do so and you may have excess contribution to deal with. Number 3, use direct rollovers and avoid 60-day rollovers. While it may be tempting to give yourself a free 60-day loan, it's generally a mistake to use 60-day rollovers rather than direct trustee-to-trustee rollovers. If the plan sends the money to you, it's required to withhold 20% of the taxable amount. If you later want to roll over the entire amount of the original distribution over to an IRA, you'll need to use other sources to make up the 20% the plan withheld. In addition, there's no need to taunt the rollover gods by risking inadvertent violation of the 60-day limit. Number 4, pitfall to avoid is remember the 10% penalty tax. Taxable distributions you receive from a 401k plan before age 59 and a half are normally subject to a 10% early distribution penalty. But a special rule lets you avoid the tax if you receive your distribution as a result of leaving your job during or after the year you turn age 55. But this special rule doesn't carry over to IRAs. If you roll your distribution over to an IRA, you'll need to wait until age 59 and a half before you can withdraw those dollars from the IRA without the 10% penalty, unless another exception applies. So if you think you may need to use your funds before age 59 and a half, a rollover to an IRA could be a costly mistake. Number 5, learn about net unrealized appreciation, NUA. If your 401k plan distribution includes employer stock that's appreciated over the years, rolling that stock over into an IRA could be a serious mistake. Normally, distributions from a 401k plan are subject to ordinary income taxes, but a special rule applies when you receive a distribution of employer stock from your plan. You pay ordinary income tax only on the cost of the stock at the time it was purchased for you by the plan. Any appreciation in the stock generally receives more favorable long-term capital gains treatment regardless of how long you've owned the stock. Any additional appreciation after the stock is distributed to you is either long-term or short-term capital gains depending on your holding period. These special NUA rules don't apply if you roll the stock over to an IRA. And number 6, and if you're rolling over Roth 401k dollars to a Roth IRA, if you establish your first Roth IRA to accept the rollover of the Roth 401k dollars, you'll have to wait 5 more years until your distribution from the Roth IRA will be qualified and tax-free, regardless of whether or not you've met the 5-year requirement in your employer plan. So, if you have a Roth 401k and you think at some point you might want to roll it into a Roth IRA, you might want to open one now, so the clock starts ticking on that 5-year requirement as soon as possible. This assumes you don't already have a Roth IRA. But I caution you, when evaluating whether to initiate a rollover from an employer plan to an IRA, always be sure to 1. Ask about the possible surrender charges that may be imposed by your employer plan or new surrender charges that your IRA may impose. 2. Compare investment fees and expenses charged by your IRA and investment funds with those charged by your employer plan, if any. And number 3, understand any accumulated rights or guarantees that you may be giving up by transferring funds out of your employer plan. Once again, this is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the like icon and don't forget to subscribe to my YouTube channel to receive our weekly video podcast every Monday morning. Thank you for watching, and I will see you all next week.